This is a flip lesson to do with inventories control. The most important and obvious thing to talk to you about inventories is that it's item held for the business to make a profit. So the more they sell, the higher profit they make. Now, before I start, I must talk to you about the importance of inventories. Now, you can do this in a practical sense by playing these old favourite games of mine. One's called Lake Loquax, and I no doubt you've come across Lemonade Stand Game. If you wish, you can click on any one of these and play them, and from that work out what the importance of inventories are, so you can get it and appreciate it in a practical sense. So the importance of inventories, that they are the driver of sales and profit for the business. I think that's pretty obvious. The more we sell, the higher the profit will be, and that's the aim of going into business. So that's what I've just said. And also it means that we have a higher cash flow, so that we're able to pay for all the other expenses in our business and our suppliers and so forth. Now, the other important thing about inventories is that we have a lot of money invested in it, so it's crucial that we manage them in the best way possible. If we have too much, it's a waste. If we don't have enough, we tend to turn people away. So we also need to have the right type of inventories so that people buy them, and obviously also they need to be at the right price. So if we have what people want at the right price, obviously they're going to buy. And in relation to that as well, it's the quality and type of goods offered for sale that are crucial in this. If we don't have things that people want, then we're going to have inventories lying about, not turning over quickly, and we're not making money. We also need to offer a range of inventory that the customers can choose from. If we have a low range, that means that people are not going to want to come to our shop that often, and therefore we don't sell as much. But having said that, a bigger range means a high level of inventories, high investment, and higher costs in terms of having those inventories. Now, we use the perpetual inventory method. There's two methods, but one that we have to know for this course, and that's called the perpetual inventory method. Perpetual meaning continuous. So we have an accounting system that keeps a continuous records of all inventories purchased and sold. So at any one time, the system can answer what are our level of inventories at this particular point in time, and that in terms of management is really important, and that in terms of profit determination is also important. So as part of inventory control, we must keep record of the cost price, the cost of goods sold, and the sale price of inventory. That's the sale price. The difference between the two enables us to make a profit and also pay for all our costs. So the difference between the two is really important. So having a record of those aspects is really important. This record is kept on a thing called stock cards. So each item will have a stock card that registers how many we've got, what types, how many we've still got on store, how many have we sold, and so forth. Now, an important part of keeping check of our inventories is also to do a stock take. Having a record is one thing, but to make sure that what's in a record actually ties up with what we physically got on hand is really important, because often there are some differences, and I'll explain in a moment why. Sometimes there's a discrepancy between what we see in a stock take and what's actually on our records, and for that purpose we must make an adjustment. We can make adjustments either in terms of a stock loss or a stock gain. There's a clip here to help you understand that. Now let's look at some examples how a stock loss can occur. The most obvious one is theft. It's not only through the customers, but in a lot of cases staff as well. Oversupply to a customer, so we've supplied too much to a customer, more than our records show. And the other side of things is that we may have got less from a supplier than we thought we would, and therefore our records are incorrect. therefore we've got less in stock. Quite often damages occur and breakages, either through people not being careful or just the nature of the goods. For example, if we deal with vegetables, there's also amount that go off in that time, so that would have to be adjusted as well, and quite often errors occur. In terms of a gain, we can have oversupply from a supplier, so we've received too much or we've supplied too little to a customer, or again there can be a stock taking error. Now the general journal entries are really important. You must be able to do one of these again for the financial statement for balance day adjustment. Here is a clip that helps you identify that in a more detailed way than I'm going to do it here. So please have a look at that. You'll find that on the blog, and I'll show you where that is now. So when you go to the blog, you can either see this inventory adjustment clip section there, or if you type up here inventory adjustment, it'll take you so you can find those clips. When you press on that, you're going to get this, and just click play, and the way you go. What is the impact on profit in relation to inventory adjustment? It's important to understand this. If we have a loss, so if we haven't got as many as we thought we had, it's a cost to us, therefore we'll record it as an expense, and if we record an expense, it's going to decrease our profit. Correspondingly, if we have a gain, it becomes a revenue, and therefore it increases the profit. If we look at the asset side, in the case of inventory loss, we're going to debit the expense and credit inventory control. That's an asset account. Therefore, our assets are going to be down, and correspondingly, for an inventory gain, our assets are going to be valued up, and therefore we have a gain in terms of our valuation of our inventory. There's three main areas that I want to look at in terms of the importance of controlling or managing our inventories. First of all, in storage, purchase and sale, and also the size and level of inventories. When we talk about managing inventories, we also have to include storage and security. Some inventory items are stolen, they're lost, damaged or spoilt in the case of my vegetables that I talked about before. And in all these cases we have to recognise an inventory adjustment, but the important thing to realise is that it leads to discounting our items, which means lower margins and lower profits. We also need to ensure that we prevent theft and pilfering by staff, and therefore we need to include some security methods. So we've got tags on our items, we use scanners, there's security cameras, where in some instances there's bag checks and security staff. So they're all measures that people use to manage their inventories. Now let's have a look at this at the purchase side. A lot of businesses use just-in-time purchasing to maintain optimum level of inventories. Remember I talked to you before about if you have too high inventories or too low inventories, that causes troubles on either end. The important thing to note here that you have a big investment in inventories. Some businesses, even though they're small, they have tens of thousands tied up in inventory, so it's a big investment. If we have too little inventories, it turns off customers if the range isn't as big, or if there are enough sizes, or if the actual items aren't there. And that's typically the case in smaller places like Launceston. Too much inventory increases the cost of storage, the rental of premises, and the warehouse. Obviously the cost in the actual items themselves. Another thing we need to consider is to manage the reorder point, the reorder quantity, and the lead-in time for delivery. And this ties in explicitly to our just-in-time purchasing concept. If we're able to pinpoint for our perpetual inventory system when we say got 5 left, Then our reorder quantity might be that and every time we reorder we buy 10, and it may need 3 or 4 days. So if we think that we're going to sell, say, 5, and it's going to take us 3 or 4 days, then that will be okay to replenish our level of inventories for that particular item. And if that's not managed, you don't have any in a store, customers won't like it, so forth. If you buy the wrong inventories, that means that you will have to obviously get rid of them in a sale. We reduce your margins and so forth. In relation to managing inventories to sell, a lot of businesses take orders and freight in the inventories the next day, which again goes in line with the just-in-time purchasing. So you don't have too much on your shelves, which reduces the cost of holding inventories. You make sure that you get your orders away quickly and deliver them quickly, so customers are happy. And you also want to maintain accurate inventory levels. Quite often you go into a store and they say they've got something there, but they physically can't find it. So it's important that you have accurate inventory levels to keep keep customers happy. Other important thing here is that we want to maintain or increase our inventory turnover as quick as we can, because every time we sell one item of inventory, we make that extra margin, extra profit to cover our costs and so forth. Lastly, I want to talk to you about the inventory turnover. So you can see from this simple diagram here, if you increase your turnover, you decrease your costs and increase your profits. That's what it's all about. Here is the formula that you use to calculate the inventory turnover, also called the stock turnover. You calculate it by taking the cost of goods sold and dividing it by your average stock. This level of turnover will vary from industry to industry, and as I've already indicated a number of times, the higher the better. Now let me give you an example using some figures. Our cost of goods sold from our income statement, you can see, is 265,000. Our inventories at the start of the year were 90,000. At the end of the year, they were 110,000. So therefore, the average inventories for the year is 90,000 plus 110,000 divided by 2, which is 100,000. Now let's recap. The formula is equal to the cost of goods sold divided by average inventories, which we just calculated. Let's put in the numbers. So it's 265,000, which I gave to you earlier, divided by the average inventories, 100,000. You do your calculation and you get 2.65. That means that our total value or average value of inventories of 100,000 is turned over 2.65 times a year. So ideally next year you would like to increase that to a figure higher than that.